What I find amazing is the Federal Reserve, and I think a lot of mainstream analysts have difficulty discerning between secular trends and cyclical trends. And what we have now is a good example, and what happened in 2016 to 18 is a good example. So we know that the growth rate in the economy is in a secular decline, both real growth and nominal growth. And every time we have a little bit of an increase in the rate of growth or in inflation, it says that's the secular change that we were looking for. We're going to hit escape velocity and the growth rate's going to continue to rise. But what that rise is it's a cyclical rise, not a secular rise. It's a cyclical rise. And they always tighten into cyclical strength, confusing a cyclical trend for a secular shift. And that's the main problem.
Welcome to the GoldRepublic Podcast. My name is Bart Brand.
And I'm Alexej Bart. In our weekly podcast, we invite guests from all over the world to get valuable insights
into the emergence of a new monetary system through the lens of precious metals, cryptocurrencies, and other financial instruments.
Welcome to the GoldRepublic Podcast. Today we have the great honor of welcoming Eric Basmajian. He is the director and founder of EPB Macro Research. And I've been actually following you, Eric, since I've seen the interview with Lynn Alden. Very compact, very insightful, very articulated. And you also have very insightful charts on your Twitter regularly. My first question to you is, what drives you into finance, and how basically did you evolve being now only 28 years old, being such actually, kind of a reference in some macro insights?
Yeah, thank you. And thank you for having me on the podcast. I grew up in a house where finance was prevalent. I got my education in economics at New York University. And at that time, I wanted to work on the buy side. So after school, I jumped straight to a hedge fund. It was a quantitative hedge fund specializing in equity derivatives. So we'd scan tens or hundreds of thousands of options per day and look for what we thought were mispricings. It was a great experience. I learned a lot of statistical techniques, got to work with some very, very smart quants programmers. It was a little bit out of the economics and macro realm that I was passionate about. So while I was working there on the side, I continued my study personally of economics and long-term secular economic trends, debt deflation, demographics, things that impact the long-term trends in the economy. And having experience at the hedge fund, these long-term trends were very important and very powerful. But I was very in tune with the idea that quarterly or even yearly or even monthly performance was extremely important. And if you only had a 3 to 5 year view, you may be proven correct time and time again, but it will be tough to navigate the short-term cyclical ups and downs. You have to be in a quite unique position as a money manager to have a 3 to 5 year window where you can stay the course. So that led me to continue my education on my own, studying business cycle experts like Jeffrey Moore, who is the co-founder of Economic Cycle Research Institute. And what this approach did was it allowed me to build a comprehensive library of what we call leading economic indicators. These are indicators that over many economic cycles, over decades, lead turning points. They precede recessions and precede expansions. So what I did was I took the two concepts. I took the long-term secular economic trends and I married it with short-term cyclical economic trends to provide clients with both a long-term framework as well as a cyclical approach over the next 6 to 18 months, which is more palatable for performance. So after studying that for several years, I decided to leave the hedge fund and start publishing this research on my own. I quickly gained a following and there was some traction, so I continued to do it. And 5.5 years later, here we are. And the process has been receptive to a lot of people. And I'm excited to share some of my views today.
Awesome. I'm curious, when you started, you had already, I guess it was the very beginning of your modeling of your leading indicators. How would you now look back on the ones you modeled like 5.5 years ago to now, and how much did actually it happen? How much did you tweak? What's the, let's say, the learning of that process?
So it's an extremely iterative process. I've read some of the same books and papers dozens of times, and you read one paper, you go back 3-4 times and you find something slightly different. And one of the interesting parts of this process was some of these indicators that have stood the test of time. It's very important when looking at leading indicators or anything in the economy that an indicator stands the test of time, meaning it can last decades. And people often say now, well, times are different now. What worked then doesn't work now. Well, the economy, in a free market economy, it moves in cycles. It will always move in cycles. There are some natural forces in the economy that won't change regardless of central banks, politics, and things like that. So you have to go back and you have to look at the indicators that worked many decades ago. Now, part of the problem with that is some of those data points are either not in publication today. They've changed their name. A different company has started to publish that time series. So part of the process is finding the correct economic data point that has economic relevance and it leads economic cycles for a reason, and then trying to find what the closest example of that would be today. And that process takes a little bit of time. And it's extremely important that when you go back, you're not looking for what we call data fitting, right? You're not looking for two indicators that overlay each other nicely on a chart that have no economic significance. There's all kinds of websites that put these spurious correlations of avocados and Bitcoin prices, for example, and they overlay nicely on a chart, but it emphasizes the point that you can find things that are correlated for short periods of time with no economic significance. So it's extremely important when you're developing and finding these leading economic indicators that you start from a place of economic significance. It has to make sense, and it has to be sound economics for it to be an applicable leading indicator and last many, many decades. Because if it's not grounded in sound fundamental economics, the correlation will change over time as factors change. But the economy, as a free market economy that moves in cycles, these indicators will always precede more coincident or lagging data.
Which ones sustained throughout time? The leading indicators so you've basically talked about as indicators, or let's say call them anchors.
Exactly. So a great example would be something like building permits, right? So what's the economic significance of building permits? Well, you need a permit before you start new construction, right? You can't possibly have new construction prior to a permit. So logically, a permit would have to lead the sequence of construction. So that would be an example of something that follows a logical economic sequence. It stood the test of time. Another example would be the average work week or the average weekly hours, which would lead employment. Why is that? Because if a company is running into profit issues or margin issues, firing people and hiring people is costly. There's a lot of friction to it. So what you may do first is you may reduce the hours worked of your staff. So if you see a large reduction in hours worked, that generally precedes a change in employment conditions. And again, that follows a logical sequence. And it's very unlikely that you see a company go straight to layoffs before you see them reduce the aggregate hours worked of their whole staff. So those would be two examples of leading economic indicators that have a logical flow and have stood the test of time. And we can get into more if you'd like, but that's sort of the framework and the thought process that I try and get across.
Well, I was just wondering, these leading indicators and the correlation, what correlation or what moment in time would you say fits the situation that we are in right now, the worldwide pandemic and not before seen government stimulus? What do you think is the best correlation in something that we can see that happened in the past?
Sure. So one great example that we can get a good read on right now would be industrial commodity prices, right? And why industrial commodity prices? Because as you mentioned, we do have distortions in data series that we haven't seen before. For example, lockdowns, which caused economic data to fall very sharply, sort of a mandated recession, right? So and other data like employment can be skewed from enhanced stimulus, which is maybe keeping people out of the labor force. Commodity prices is something that we use every day. It's part of the industrial process. And what ended up happening after the pandemic or shortly after it began, when the government mandated everyone to stay at home, was that people couldn't consume services. They could only consume goods, things that you can consume at home. So that jump-started a major manufacturing boom across the entire global economy because the industrial cycle is very tightly correlated globally. It's very difficult to have an industrial upturn in China without an industrial upturn in Germany. The two are very, very correlated. So right now, what's giving a great signal on the global industrial economy and this whole manufacturing impulse that's rippled through the world, a very clean indicator would be industrial commodity prices. And I have several baskets of industrial commodity prices that I track, and I track the growth rate. Everything that I analyze is in a rate of change or second derivative. So what that means is if industrial commodity prices are going up at 50% per year, and then they slow, and now they're only going up 25% per year, they're still going up, but the rate of increase has slowed. And that change in direction is the factor that I'm looking for. So these baskets of industrial commodities, everyone gravitates towards copper and oil, and these are great indicators of the global economy. But as we know, they can be heavily speculated on in futures markets, and some of their price signal may be distorted by speculation versus economic fundamentals. So what we really want to look at is we want to find industrial commodity prices that aren't as influenced from speculative price movements. So, for example, the Commodity Research Bureau, the CRB, publishes baskets of commodities that include things like rosin, rubber, tallow, wool tops, things that you don't have a chance to speculate on in markets, but have tremendous industrial use. And what we've seen over the past several months is that the growth rate or the rate of increase in these commodities peaked in March as we transitioned from March to April, and now they've come down pretty dramatically. So what that tells me is that the most fierce impulse of the global manufacturing sector is now starting to fade. So industrial commodity prices, as a very long-winded answer to your question, is one indicator that I think has a lot of relevance today because the upturn in economic growth was so concentrated in the industrial sector because of a lot of the forced political moves that happened.
Fascinating. And so what would be then the macro outlook now for the next 5 to 10 years in general? How do you situate it, and where are we now and where are we heading in this 5 to 10 years?
Sure. So as I mentioned in the beginning, I have two time frames to my analysis. I have the long-term secular economic trends and then the shorter-term cyclical economic trends. The secular economic trends are 3+ years. Most often several decades. These secular trends don't change very often. The cyclical trends are more in the 6 to 18 month window. So if we're looking at the next 5 years, we're looking exclusively at secular economic trends. And the two most important secular economic trends that I look at are demographics and debt. So why is that? Because long-term economic growth is a function of population and productivity. How many people are there and how productive are those people? So we can break it down into looking at demographics, looking at population growth and workforce growth, and then looking at the factors that influence productivity. So if we go with demographics first, the most clean example would be just to look at future population projections for the global economy, for the U.S. economy. And for the U.S. economy and the global economy, population growth is expected to decline over the next several years, next several decades. It's been declining. The growth rate in the population has been coming down in the U.S. It's been coming down developed countries. And that trend is going to continue. So there's going to be a demographic drag across the entire global economy in China, in Europe, in Japan, in the United States. The demographic drag in the U.S. is not going to be as bad as China, Europe, and Japan. We have pretty reasonable forecasts about population growth that don't change very often. So from a rate of change perspective, demographics are going to be helping less than they did in the past. So the next 5 to 10 years, we can expect a drag from demographics, and we can get into what that drag looks like. Then the other factor is productivity. And productivity for the aggregate economy has been falling. And that sounds counterintuitive because we have all this new technology and it sounds like everyone's getting more productive, and it's true. What's happening is individual workers are getting more productive. So if you look at GDP per worker, that's going up, meaning every individual worker is getting more productive. However, productivity for the whole society is coming down, or the growth rate's coming down, because as technology is improving, we're requiring less labor. We're requiring less people. So if you two were part of a company and Bart, you got twice as productive, but you lost your job, the aggregate productivity, and then you stayed at home and couldn't find a job, the aggregate productivity didn't change, although the productivity per worker doubled. And that's sort of the trend that's going on now. So we have demographics that's going to cause a drag in economic growth, and then we have productivity, which has been coming down. Productivity has been coming down because of a condition of over-indebtedness. It's over-indebtedness that's in the government sector and it's in the private sector. It's not exclusive to just public debt. And debt isn't always necessarily bad. If you borrow money and that use of funds generates an income stream and you can repay your debt and then it keeps generating an income stream in the future, that's fantastic. That'll increase what we call the velocity of money. The problem in the United States and globally is that the debt that we've been taking on, both in the public sector and in the private sector, is not geared towards a productive income stream. It's geared towards, on the government sector, it's geared mainly towards transfer payments. And on the private sector, it's geared mainly towards financial speculation. Both of those don't contribute to economic growth. So what's happening is we're increasing our level of debt without increasing our productivity. And over the next 5 to 10 years, we're going to have a drag from demographics. We're going to have a drag from debt. And that's going to make the rate of economic growth and likely the rate of inflation come down over the next 5 to 10 years.
So you just said it. Inflation would go down.
That's correct.
Okay. So that's actually a good segue to the next question, which is obviously something we like to always ask our guests, and who have different narratives or camps, quote unquote, as I would say, inflation versus deflation in the longer term. So 3 to 10 years in your own time frames. So what would you say is then more dominant, inflation or deflation? You've already hinted towards it, but what is, let's say, your case against all the inflationistas? I'm going to say it again.
Yeah. So I don't want to make a call that the U.S. is going to slip into or stay in permanent deflation like Japan. Japan has a more serious case of deflation, and part of that is because their population growth is negative, right? So they have a demographic drag that is probably the most extreme in the world. Maybe Italy is weak demographics as well. So just on a demographic basis alone, the U.S. won't struggle as much as a country like Japan. But with that said, the rate of change is still moving lower. So the way I would describe it is a continued case of disinflation. So we all know over the last 20, 30 years, the rate of inflation has been coming down. We still have positive inflation, but it's moved from 5% to 4% to 3% to 2%. And over the next 5 years, I think that's going to continue grinding lower and lower. I don't foresee in the next 5 years the U.S. getting stuck with negative inflation, but I do see the rate of inflation continuing to grind lower over time. And we can get into the specific inflation arguments. The one that we hear most often is that fiscal stimulus will prevent inflation from falling too fast. That's never been proven historically. The examples that we reference now have a lot of differences to the current situation, like the 1940s, for example. We can get into that. But I think that the main misconception about fiscal stimulus is the diminishing marginal returns that get triggered when you overuse debt capital. And a lot of the inflationists are thinking in accounting terms and rows and columns, where if the government spends $5 trillion today, and then they spend $6 trillion tomorrow and $7 trillion in the future, as long as they keep spending more and more money, they can always keep the rate of inflation positive. But what's actually happening is you trigger diminishing marginal returns, where you can spend $5 trillion today and get $1 trillion worth of growth. You could spend the same $5 trillion tomorrow and you'll only get $800 billion worth of growth. And that diminishing marginal returns curve continues to the point where you spend $8 trillion and you get $1 trillion of growth. You spend $10 trillion, you get $1 trillion of growth. You spend $100 trillion, you get $1 trillion of growth. So a lot of the inflationists will say, well, if the government spent $50 trillion today, would there be inflation? Of course, right? Of course, prices would rise, but my question would be, what happens next year? If they don't spend the $50 trillion again, wouldn't the prices come right back down, right? If you gave everyone, you would need more, right? Okay, so let's work with that. So let's say they spent $50 trillion today. You'd have a rise in prices. If they want to sustain that rise in prices, they would need to spend the $50 trillion again, right? Well, not right. Because one, they need to spend more than they spent because you need growth, right? You can't, if you do 50 and 50, that's a 0% growth rate. So you need 50 plus a couple percent if you want growth. Secondly, is you have to account for the diminishing marginal returns. So if you spent 5 trillion and got $1 trillion of growth, now you may need to spend 5.5 to account for a little bit extra, but you really may need to spend about 6.5 to get the same one, because you need to account for more spending than the year before in growth rate terms, and then you need to account for the diminishing marginal returns. And this is stuff that we can prove mathematically in terms of how much growth we're generating per dollar of debt. This isn't a theory. We can see this play out over time. So if we go down this road of fiscal stimulus is the way to solve our inflation problem, what we're quickly going to find out is we're going to start to spend $5, $6, $7, $8 trillion per year, and the economic growth rate is not going to be any higher than it was before. In fact, it's going to grind lower. You'll have a spike up in growth, and then they won't be able to maintain it, and then it'll continue to trickle down like that. The chart that I wanted to show is this chart on real GDP per capita. And this is one of my favorite charts because it shows the nonlinear decline that happens when an economy gets over indebted. And can you see my cursor here?
Yeah.
If I drag it across. So this is real GDP per capita. And this is the closest definition that we can get to the standard of living, right? So how much is the economy growing per person in inflation adjusted terms? And this is a 20-year annualized growth rate. So this point here in 1980 means that for the 20 years leading up to 1980, the economy sustained a growth rate of about 2.7, 2.8% in real per capita terms. So that's a 20-year period of over 2.5% growth. And what we see is we maintain growth consistently of 2.5%. And as the economy became more indebted, it started to come down, And now what I want to really emphasize here is this decline that we're seeing is the non-linear relationship. That's the non-linear decline that a lot of people who are focused on fiscal stimulus in accounting or dollar terms are not, in my opinion, willing to accept. So what's going to happen if we continue to pursue this path of high levels of indebtedness is that this relationship's not going to change. It's actually going to continue to get worse. So if we graph what an upside down U or a parabolic relationship looks like, what's going to happen is it's going to start to look like this. And then now we're at such a high level of indebtedness, the growth rate's going to start to come down like that. And now you still may have positive growth, because if we go from 1.3, down to here, we're still at positive growth. But if we look at the long-term trend, that, upside down U or parabola is going to continue as we continue grinding to higher levels of indebtedness.
Does that correlate with the indebtedness of the United States? Actually, because you always see per administration that the debt bubble grows twice as large. So from the Bush era, they went from 0 to 4 or 5 trillion. Then Obama made it 10 trillion. Then I think that Trump made it 20 trillion. And with the new administration, I wouldn't be surprised if it became 40 trillion within a couple years.
Yeah, that trend is going to continue, and it's going to continue for structural reasons as well. So a majority of the structural debt in the United States is what we call transfer payments: Medicare, Medicaid, Social Security, unemployment, things like that. And what we've seen is that in the 1950s and 1960s, transfer payments, those categories that I just mentioned, represented about 5% of total income. So one of the ways you could think about it was the government was responsible for distributing about 5% of the total income in the country. That's steadily grown over time. Before COVID, it was about 17%. So the government had grown by about 12% if you're looking at how much income they were responsible for redistributing, you could say. We grew from 5% to 17%. Then COVID happened, and that number jumped to about 35%. The government was at one point distributing about 35% of total income. As some of this stimulus has worn off, that's come down to about 25%. But if we look over the next 5 to 10 years, going back to one of your earlier questions, just the demographic situation alone is going to cause a structural rise in government transfer payments as a percentage of income. So the government right now went from 5% to 10% to 20% to 25%. Over the next 10, 20, 30 years, we're going to go from 25 to 30 to 40 to 50%. And why is that a problem? It's a problem because there's been tremendous amount of research done on government size and growth, and we can get into the specifics of what is causing that. But what the research shows, and it's crystal clear, is that when government size increases by about 10 percentage points, you get a 0.5 to 1% reduction in economic growth. And if we just try and do a back of the envelope calculation, in the 1950s and 60s, we were at 5% government transfer payments as a percentage of the total. We've gone to about 25% now. So we've increased 20 percentage points. The research would have us have a growth rate, a trending rate of growth that declines in between 1 and 2 percentage points as a result of that. And that's exactly what's happened. We've gone from 2.5 to 3 down to 1.5.
Would you say there's also like some correlation between when we look at, in the case now of the United States of America, demographics and the 10-year bond yields, treasury bond yields in general, like the steep decline as well?
Absolutely. Because ultimately the direction of bond yields, the direction of risk-free bond yields will track the direction of economic growth. And like we discussed earlier, economic growth will be a function of demographics and productivity. So if one leg of the growth equation, demographics, is coming down, that's going to pull aggregate economic growth lower. And if aggregate economic growth is pulled lower, then bond yields will follow. So yeah, I believe that correlation is valid.
Aren't we then heading into the territory of applying MMT, not only in the United States, by the way, also in of course in Europe, maybe even as the first one to do it in Japan?
Yep. So this is an extremely important point, and I want to make a really clear distinction about what we're talking about when we say MMT. The way that I see MMT thrown around a lot is just really big deficits. And if that's what MMT is, it's not any different than what we've done in the past. The numbers are just bigger. If the Biden administration comes out and says we're going to spend $5 trillion every year for the next 4 years, but we're not going to change the monetary system, we're not going to change how we go about doing this spending, the Treasury is going to issue the debt, even if the Federal Reserve buys it through quantitative easing, we're not changing any of the economic systems or economic relationships that have been in place over the last 20 to 30 years. So if MMT just means really big deficits, then nothing changes. We're going to continue grinding to lower levels of economic growth. If true MMT, in my mind, requires a change in the monetary system, which would be Biden is going to spend $5 trillion, but we're not going to issue any debt. The Federal Reserve is going to grant you money in your Federal Reserve account. This is the central bank digital currency, or these Fed Now accounts that have started to come out. Under the current law, the Fed can't do that. You can't have an account at the Federal Reserve and the Federal Reserve place money in it. That's not allowed. So if that's the direction that we go in, if we facilitate large amounts of spending through a change in the system where the Federal Reserve can facilitate that spending directly, the Federal Reserve can create money and place it in your account, that would be a different regime. That would be inflationary. But I don't think that that's the path that we're on right now, because it would require a change in law. And we've seen a lot of Fed governors, we've seen come out and talk about these central bank digital currencies or these Fed Now accounts. And they seem pretty consistent in their belief that it would require a change in the Federal Reserve Act to do that.
Talking about the Fed, the Jackson Hole meeting is approaching. There's been already some governors of the Fed saying and actually moving from dovish to more hawkish, signifying a more taper-driven approach up to until apparently the end of the year, according to some reports. What do you believe will be the outcome of this Fed meeting, and what will be the implications on the current economy, which is actually, it's under stress in many levels. The stock market is always hitting all-time highs. We have, the economy running also hot in many ways. The recovery seems to be picking up in some factors. What is your view on it?
So the Federal Reserve has a dual mandate, which is employment and price stability, or employment and inflation. Some people say their third mandate is the stock market, but let's just go with employment and inflation. When we look at going back to my process of these leading economic indicators and the sequence of economic events being extremely important, inflation and employment are towards the lagging end of that spectrum, right? So when the Federal Reserve anchors on employment and inflation, by definition, they're always going to be missing the cyclical inflection points, right? So what we see now is inflation numbers are really, really high. But we knew that inflation was going to be trending higher for the last 7 or 8 months. Leading indicators of inflation started to turn higher in the summer of 2020. So we've had over a year of, inflation's going to go up. Fed, we know inflation's going to go up. Now inflation gets, based on the way I calculate it, over the last 6 months, it's been about 6.5%. Now they're saying we're going to tighten, right? And invariably what's going to happen, whether they start tightening in September or December or a little bit later, the growth rate in the economy is already starting to come down. And I can try and pop a chart up of this as well.
So it's being late at the party again.
That's exactly right. So this chart here is, sorry about that. This chart here is what we call coincident economic data. So this is not leading data. This is the actual economy, what I call the four corners of the economy. You have production, employment, consumption, and income. These are the four corners of the economy. And everything is graphed in real or inflation-adjusted terms. So what we know is that over the past 12 months, the growth rate in the economy was increasing across any metric you look at: employment, income, consumption, and we knew it, growth was going up. Around April, May, the growth rate started to come down. Growth rate's coming down for production, it's coming down for consumption, it's certainly coming down for income because incomes can't keep up with inflation. And what do we have here? We have employment, the lagging one of the four, which is still looking pretty good. Again, everything's graphed in growth rate terms. So if we combine all four of these indicators, which is what I do, into what I call a coincident index, what we have here is a good, solid read on the four corners of the economy pushed into one index. The economy was accelerating dramatically, and when the economy is accelerating, generally it can handle an increase in interest rates. It can handle Fed tightening because economic momentum is to the upside. What we have here is that the economy peaked in March and April in real growth rate terms. Now the growth rate's coming down, and we use leading indicators and secular economic trends to forecast, is this going to continue declining or is this going to start to increase? And this growth rate is going to continue declining, and the Federal Reserve is going to start to tighten into a declining growth rate, which is one of their really common moves that they like to do. They seem to do it quite often, and I think it's based on. I think it has to do with the fact that their mandate basically locks them into always being late. So what we're going to have here is we're going to have the growth rate of the economy coming down into Fed tightening, which will pose some problems, I believe.
Yeah, because indeed, like you said, it's what the Fed does. Then whenever the economy starts a downturn, they start to tighten, which is exactly right. The exact wrong
right
thing
when the
to do.
downturn is starting,
Yeah.
when the economy is hitting its highest point, what's happening under the surface is that the leading cyclical components are already coming down, but the lagging components are going up. So the broad index looks like it's hitting a new high, but if you try and look under the surface, you could usually see a couple quarters ahead that the more cyclical are already coming down, and that's what we see with production and things like that. So yeah, they're gonna tighten right into the slowdown, and then what happens? They tighten as the economy's slowing, and the market tries to hang on, and then it all of a sudden realizes, oh crap, they're tightening into a slowdown. The market falls apart, and then within a matter of days, the Fed goes back to easing, and we don't talk about tightening for another couple of years. And what I find amazing is the Federal Reserve, and I think a lot of mainstream analysts have difficulty discerning between secular trends and cyclical trends. And what we have now is a good example, and what happened in 2016 to 18 is a good example. So we know that the growth rate in the economy is in a secular decline, both real growth and nominal growth. And every time we have a little bit of an increase in the rate of growth or in inflation, it says that's the secular change that we were looking for. We're going to hit escape velocity, and the growth rate's going to continue to rise. But what that rise is it's a cyclical rise. Not a secular rise, it's a cyclical rise. And they always tighten into cyclical strength, confusing a cyclical trend for a secular shift. And that's the main problem.
I love how you articulated this. It makes it much more clearer, actually. And also, talking now about fiscal and monetary policy, and we've also touched upon this also in other episodes previously, and many others did outside of this podcast as well, that you can see this convergence of monetary and fiscal policy. Janet Yellen, in the case of the U.S., is a former Fed chairman, and she's now the U.S. Secretary of U.S. Treasury Secretary. So she applies her Fed kind of thinking into U.S. domestic, kind of policies, right? So
absolutely.
Now you see basically, and she's a Democrat, and Powell is I think more of a Republican, but both must have thought, oh well, we kind of got out of this crisis pretty well. Giving the fake sense of bias that they made it and that they can reproduce this little trick, this wizardry one more time, and giving kind of like this incentive to continue doing so. When you think about it and let it sink in for a second, we had the quickest recession and quickest recovery in history. It's a bit weird as well, and the fact that this could go on is also a bit a symptom to maybe a system that has been used too many times, or just like the analogy that some commentators give of the junkie being overshot with drugs, that the drug doesn't kick in anymore because the resilience of it has passed threshold. How does that say about then the system in general? Like, how could it still be operating in ways that we could actually know what's happening, because it's now convoluted and polluted with all those measures which are not letting the market actually do what it's supposed to do?
That's such a great point. And where I come out on this is all of these distortions will end up resulting in worse economic growth in real per capita terms. And I'll give you a couple reasons why that's the case. And this goes back to the inflationists that have the belief that continued fiscal stimulus will always yield the results that the politicians want. And again, that's not dealing with the economics of the system. It's dealing with just numbers. 4 trillion means this. And what the research on government size and growth shows is it gives reasons why economic growth starts to decline as government size grows. And there's econometric reasons, like we talked about, in terms of diminishing marginal returns and overusing a factor of production. But I think what you're getting at is the government distortions. So when government size, let's say the government is responsible for 50% of the economy, what ends up happening is special interest groups emerge. There are political factors that now supersede the goal of increasing the standard of living of the population or increasing economic growth. So if we take the CARES Act, for example, or any of the last 3 stimulus bills that have been passed, it's really difficult to tell. But everyone can look at these packages and realize that a significant portion of them is what we call pork, or going towards special interests, people just taking money off the top that's going to have absolutely no impact on economic growth. And as government size grows and the amount of money that they're willing to spend goes from 1 trillion to 7 trillion, there's going to be a lot more hands that are looking to get a piece of that. And the way that typically evolves in an economy as the government gets bigger is these distorting effects get larger, and that reduces the rate of real economic growth. Another concept that I would challenge people to think about is most people would agree that a 100% government command and control economy would yield worse results than a totally free market open society. I think most people generally agree with that philosophy. So it stands to reason that if there's a spectrum of 0% government control and 100% government control, and if 100 yields worse results than 0, as you move in this direction, the results are going to get worse, not better. we seem to have this belief that 100% government command and control doesn't really work anywhere. But if we just do a little bit more than we're doing now, we'll get the right mix and we'll get great results. But what we're not really willing to grapple with is that every time government size grows, they're getting closer and closer and closer to 100% control or a command and control economy, which we know yields worse results. So to me, it's a real logical impediment that 20% government size didn't work out. 40% will, but 100% won't. There's a logical inconsistency there. So I think the point that you're getting at is the government size is growing. We have more political influence. There's a lot of factors at work in terms of social benefits that have now taken center stage. There's a tremendous amount of factors that are becoming the more important issue versus economic growth. And as we move closer and closer to the system that I described, we could only expect the results to get worse, not better.